Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Joining us now, we won't be patient at all. Zach Griffiths of CreditSights alongside Rubeela Farooqi of High Frequency Economics. Rubeela, a question that I had last week, many others as well. The data last week, never mind opening the door to September, does it open the door for a real conversation, a live meeting in July about cutting interest rates?
Good morning. We think the data cumulatively, if you look at the growth side of things, if you look at spending, if you look at inflation, and then, on top of that, what you're seeing in the labor force. What you're seeing is there's better balance between inflation and the labor market. And we do think that there's enough evidence in the data to at least start the conversation. We don't think there's enough for them to move in the July meeting. They get more information between July and September that's going to be important. So I don't think they need to rush the decision. And also, this Fed is very careful about not surprising the markets. But I think the discussion definitely can start, especially if our outlook, if things do turn out the way we expect them to, which is an ongoing slowing in what we're seeing on the growth side, and also in terms of what we're seeing on the labor market. That is very key. That rise in the unemployment rate for 3 straight months. The unemployment rate is still very low, but perceptions about the labor market from households, they have deteriorated. And that is going to be a very key input into how households approach, the outlook for the economy and what that means for the growth path.
Zach, do you believe that we've made enough progress on inflation to put more weight on the other side of the dual mandate and focus on protecting the labor market?
I think we have, John, and I think that's what you're seeing in the minutes last week, going through just what Fed participants were talking about. The emphasis seems to be on shifting toward the labor market. That's not to say that they're not going to remain acutely focused on inflation, but I think the labor market gets a bigger weighting going forward, and we are looking for more normalization there. And to us, with a slowing growth story driven by the consumer in the second half of this year, we don't think they're going to go in July, but we agree that the conversation should begin, and we're expecting the first cut in September.
Zach, when you talk about some of the split screen that we're seeing right now in the economy, where you have certain segments that are doing very well and inflation is still a concern in those segments, I'm thinking of hotel rooms and some particular routes on airlines. On the other hand, you have a lot of places that are struggling, and you see that with the Russell 2000. In the companies that you cover, how much are you seeing real distress starting to pick up in certain companies, even as the overall picture looks stable?
We're not seeing a ton of distress, I'd say, right now, Lisa. What we're seeing is signs that the consumer is slowing down, and we're starting to see a reaction by some of these consumer goods and retail companies, not necessarily taking prices down, but doing more promotional pricing. And I think there's going to be a mismatch in timing of when that shows up in the inflation data and when it's actually taking place in the real economy and how these companies are responding to a slowing consumer. And so when we think about how that changes the balance of risks, we think that fundamentals are going to become a bigger part of the picture in terms of credit spreads in the second half of this year and first half of 2025. And that's why we have a little bit more of a widening bias versus our more bullish view that we've held for really the past 18 months or so.
Rubeela, what do you make of that, especially given that it's so bifurcated, right? I mean, you could have, for example, we're going to be getting the one-year inflation expectations from the New York Fed today at 11. We get NFIB small business optimism tomorrow. These are sort of peripheral measures that have been a little bit out of sync with the rest of everything that's going on. How much do you pay attention to that at a time where you see such dominance of particularly high-income companies and individuals fueling specific sectors of the economy?
No, I mean, it's a very important point, right? I mean, you are seeing a bifurcation. There is, a split, if you look at what high-end consumers are doing versus what, people at the bottom end of the income scale. But, if you look cumulatively, the sign is still the same. The consumer side of the economy is decelerating. We're not seeing a weakening. We're not seeing a contraction. But this is what drives the economy, and we are seeing a deceleration. What's really important is that the services side of the economy, right, that is now moderating. That is something that we have been looking for a while. And notwithstanding, what we're seeing with airline travel and, things like that, but there is a deceleration. Even if we don't, our base case remains that the combined message is that the economy is slowing, the inflation is on a decelerating path, the labor market is loosening, and those things are going to be what drives the policy path forward. And to us, that means that the Fed has to make the policy stance less restrictive sooner rather than later, managing the risk between the labor market loosening versus the labor market weakening. That is a very tricky thing, and I think the Fed is very sensitive to that. There are a lot of uncertainties. You've been discussing this, in terms of the political arena, in terms of the policy arena. Right now, the Fed has to focus on what we're seeing in the economy. And, we think that means that the Fed has to consider changing the policy stance.
Rubeela, I want to ask you a question John brought up earlier. Is this a welcome cooling you just outlined or an unwelcome deterioration?
I think it is a welcome cooling, but like I said, managing the risk between a welcome cooling and a weakening and a contraction in payrolls and a surge in the unemployment rate, that's very difficult. Chair Powell has talked about this. What they're talking about is an unexpected weakening in the labor market. So they do expect the labor market to rebalance more completely. It's just that unexpected weakening is what they're going to be ready to respond to. We're not really seeing an unexpected weakening. We are seeing a cooling, but it still, in our view, justifies making that policy rate less restrictive.
Zach, that's the stance the Federal Reserve is taking. When you speak to people about the unemployment rate, particularly in the market, I'm talking about strategists and investors specifically, they're focused on whether we trigger the SARM rule. I want to know from your perspective, Zach, and we touched on this earlier in the programme, if next month we go to, say, 4.2% on the unemployment rate or even higher, and that rule gets triggered, do you think that would trigger a broad sell-off in this market?
I think we'd have to see at least somewhat of a repricing of risk, and that's really what we're looking for, John, is this repricing of credit risk. We have spreads that are really tight, equities that are really high, and when we think about the balance of risk going forward, we're almost more concerned with that unwelcome deterioration outcome, with the Fed having held policy quite restrictive in our view, and I think there's a lot of uncertainty there, but we do think it's at a restrictive point. And if they don't start to respond to what we're seeing in the consumer, in the economy broadly, then we have a higher risk of that hard landing scenario that everyone was so fearful of in 2023, emerging perhaps in the second half of this year or first half of 2025. So we are expecting that if we do see more deterioration, perhaps at a faster pace than what we've seen so far, you're going to see that reflected in asset prices.
Hey, Zach, good to hear from you. Zach Griffiths there of CreditSights and Rubeela Farooqi of the High Frequency Economics. Henrietta Treyz of Veda Partners writing this: unless Biden improves in the polls, the screams to drop out are going to grow deafening. Team Biden is putting up a valiant effort right now to stay in the race, but it is our expectation that staying in the race is untenable, and the president will choose to step aside. Henrietta joins us now for more. Henrietta, it's wonderful to have you with us on the program. Will it be the polls, the donors, officials within the party that get the president to take that decision?
Yeah, it's interesting. They're getting all three right now. The donors are leaving the polls. The best poll that the president had in the last week was actually the Bloomberg consult poll that y'all conducted, which showed him down in every state except for Michigan and Wisconsin. He's underwater in Pennsylvania by 7 points, I believe, in the Bloomberg morning consult poll. So all three of those points, including the members, are coming out against Joe Biden right now, which is why we have 70% odds that he will ultimately decide to step aside and open this up to, as I would phrase it, the chaos of what will either be passing the torch to Vice President Kamala Harris or opening it up to sort of a contested mini convention, as they're calling it on the Democratic side now.
Range of 70% odds is a big call, Henrietta. What's the timeline you can see this unfolding?
Great question. You know, these things happen very slowly and then suddenly all at once, to paraphrase. Right now, there are a lot of different big ticket items. Y'all have been mentioning the NATO events this week and Thursday, and those are all integral. But let's step back and sort of consider this from the perspective of the average voter. No one's watching that. I mean, let's be honest, Americans are not particularly enthusiastic about foreign policy most of the year. I don't expect it to be a major driver in this narrative of the 2024 election. Obviously, Israel, Gaza, and Ukraine are important topics, but in the grand scheme of things for the American voter, that doesn't register. So what I'm looking at is, when is former President Trump going to announce his VP? The number one way to supersede that announcement is to move forward with a Democratic announcement about something else. That's going to happen at the convention next week or in the days leading up to it. I don't see a lot of rationale for Democrats to step out and say, actually, you know what we're going to do? We're going to fix all this and open it up to a new situation. Biden's going to step down before the RNC. I would expect it to occur after that. So that's about a week and a half for investors to continue waiting here. We've been through this a million times with DC. You know, they don't do anything until they absolutely have to. And this is just another example of that. So technically, you wouldn't have to get any movement on this until sort of mid-August. I think we could see something. We're already seeing a lot of movement underneath the surface, but a real action after the RNC.
But mid-August puts this potential individual that may step in to take Biden's place at a disadvantage. You right now, no Democratic candidate can beat Trump when it comes to name recognition, national stature to compete with Trump. Who would have the best chance?
Right. So that's exactly the case right now, except we're already talking about Gretchen Whitmer, Gavin Newsom, Pete Buttigieg, Kamala Harris, and name recognition in all the polls that have been conducted of those candidates is increasing rapidly. Due to this concept of the invisible primary, where voters have expected either Biden or Trump to drop out of this race all year, people are primed to learn about a new candidate. And so what you're seeing is that name recognition is going through the roof very quickly, and you're seeing improved polling for members like Kamala Harris, even Gretchen Whitmer or Gavin Newsom, which are sort of the second and third tier candidates on that list. Kamala Harris is far and away the front runner. I think what we are focusing on here is that 24% of the electorate, including mostly independents, decide who they're going to vote for after Labor Day. So there's about 60 days from now that matter most in this election, and we're not there yet. So any of these Democratic candidates, I think, have the benefit of what will be an onslaught of media, sort of free or sort of earned media, the way that we're most familiar with on the Republican side with Trump since 2016, that earned media that you don't have to pay for, that comes from just natural attention and intrigue. And that's now housed within the Democratic Party for the first time since 2016.
Henrietta, I've been confused by some of the polls after the debate and after that interview with Joe Biden on Friday night. Some have shown a widening in the gap, widening of the lead for Donald Trump. Others, like the Bloomberg Morning Consult poll, showing a narrowing of Trump's advantage in the swing states. How do you understand this? Is basically any press good press? Is it that people already knew about this and this was already factored in? How do you sort of reconcile the different narratives that we see?
I think it really hinges on, for lack of a better phrase, attention to the Democrats, certainly, but the fact that Donald Trump has not grown his base. So it's not that Trump is improving, it's that Biden is deteriorating. Trump is at his ceiling. That has been the case since November. The question is, can you beat 47, 48%, which is where Trump sort of plateaus? The bulk of Biden's supporters, 63%, are actually just people who don't like Trump. So it creates a scenario where the Democratic voter base and increasingly independents, moderates, and in particular female voters are primed to migrate to whomever the Democratic Party taps next. It really matters less who that candidate is than the fact that they're not Trump. And that's just the nature of the duality between Trump and the Democratic Party right now.
Let's catch up in the next week or so. Henrietta Treyz there, Veda Partners, with a call that the president will step aside. Pierre, Ferragu, that's quite a headline, a downgrade to Nvidia. Just tell me, what are you seeing in the company? Is it what the company's doing or what the stock price is doing that's led to this downgrade?
Yeah, it's a great question, John. What we've been doing over the last 18 months following Nvidia and being very early in seeing this AI inflection is that we've been comparing what's happening for Nvidia, what expectations are on Nvidia, with what the supply chain of Nvidia is lining up in terms of increasing capacity for this accelerating AI infrastructure deployments. And for 18 months, we've always seen expectations for Nvidia being below what the supply chain was planning. So every quarter we said they're going to beat because they're lining up more capacity than what expectations imply today. And as we did that check in the last few weeks, we realized that now when you look at expectations for Nvidia for 2025, with like data center revenues up like 50% or so, it actually lines up pretty well with what memory manufacturers are telling us about their capacity plans for HBM. It lines up pretty well with what TSMC is telling us about capacities they're lining up for CoWoS. And so we came to the conclusion that for NVIDIA to beat expectations again, we would need to see first the supply chain increasing further their capacity planning. And we felt that was a good time for us to actually signal to investors, to our clients, well, you have to be careful because this business has grown like 10x over like the last couple of years, like the data center AI business of NVIDIA. And at some point, it's going to take a breather. It's going to slow. It's going to stick where it is. And seeing expectations for NVIDIA meeting what the supply chain is anticipating felt like a good point in time to grow more cautious about the stock. And then valuation is relatively secondary. I think the valuation of NVIDIA is still reasonable, but it's rich enough to suffer if NVIDIA disappoints not by missing expectations, but by not beating them.
Pierre, there's a distinction between a valuation call where maybe it's just gotten over in its skis and it needs to pause for a bit versus the Cisco trajectory of big up, big down, how it was the darling in the early 2000s and then it really lost some luster. Do you foresee that type of reaction in NVIDIA, or do you think it might just plateau for a while or even dip before continuing its dominance over the field?
Yeah, there is no, really, we don't see any challenges on NVIDIA's market position. NVIDIA is a market leader. Like one of our key angles of understanding this market is that it's not a market in which you have to do the best chip. It's a market in which you have to do the chip that people are going to use the best. And today, NVIDIA is largely dominant in the data center for AI from that perspective. So we think they're going to continue to have a very, very strong market share. You have more room for challengers like AMD, of course, and we expect actually in-house chips to continue to take share. But NVIDIA will still by far be the dominant player. We still have very strong margins. And we don't see the AI bubble, collapsing badly and going away. It's more of the latter that at some point, after like 2-3 years of explosive growth of like resetting the size of the market to where we are today, we see a risk that things stabilizes, and that's where the stock could take a dip. And we would be very, very constructive on that and see that as an opportunity to get back in the stock, of course.
Pierre, the stock has 65 buys, 7 holds, just the 1 sell. I've got to ask you this question, almost as a friend. Just the career risk associated with not being bullish on the most bullish stock on the planet right now. Pierre, how do you think about those things when you're putting these calls together?
Thanks for the question. It's a very good one. I am an independent analyst. I don't work for a bank or for like a broker. And so my professional success is about, how much my clients value my opinion. And I think people who follow us, who support our research, value that my ability to say, maybe I'm wrong, but I see things that I was not seeing in the last 18 months. So things are changing. And I think publishing research like that might upset a couple of people because the stock reacts negatively on the day or in the couple of days following it. But overall, what really matters is we do the numbers, we do the math, we look at what Micron and Samsung and Hynix are saying, and we compare that to what expectations are for NVIDIA. We look at what TSMC is saying, and we compare that to expectations for NVIDIA. We look at where overall capex are as well, like the hyperscale capex have increased very significantly, and we think they're going to increase again very significantly next year. And so we're worried that there isn't much room for this capex to increase further beyond that. And so I think that work is always valued. So I don't feel like I'm taking a career risk.
Well, we certainly value your opinion, Pierre, and I don't think you're taking a career risk either. Pierre Ferragu of New Street Research. Pierre, thank you. This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.